There's been a big move in bond markets recently with yields spiking higher, and that's had an effect on equity markets with certain stocks selling off quite considerably. So in this video, what I'd like to do is to just step back and calm down and think about where we are relative to this recovery from the pandemic, and also where we might go in the years ahead. Because I think you really do have to take a longer term view and not panic when you get these short term, very rapid changes in markets. Now, this article in Zero Hedge explains what triggered the problem, which was an auction in 7-year US Treasuries. The article describes the auction as catastrophic. I think that's slightly overblown. All that really happened was that the bid to cover, so those are the bids to buy the Treasury note, compared to the total amount the Treasury wanted to raise, was only just over 2, whereas the average bid to cover since about 2014 has been around 2.4 to 2.5. Now, this is a long way from an auction failing, and remember that in the UK we did actually have a government bond auction fail in 2009, and what happened? Absolutely nothing. Auctions carried on after that, and the UK government continued to be able to issue new notes. But what did happen was that Treasury yields spiked as a result. And for a very brief period of time, US 10-year yields went above 1.6%. But very quickly they snapped back down to around 1.52%. Now, while that doesn't seem particularly scary if you realise that's just a 0.08% shift upwards and downwards, for the bond market that is very scary. But I think it's important to understand why yields are increasing. Remember that long-term government bond rates are driven by two things. One of them is growth expectations and the other is inflation expectations, both of which have been rising in recent months. So if we look at the 10-year Treasury rate, it's now yielding about 1.5%, but that is about twice the yield that we had in the summer of 2020. So over a very short period of time, what's happened is that the income you can get from a very safe instrument, US Treasuries, has doubled. So why does the Fed lower interest rates? Well, one of the reasons is that it forces people to buy riskier assets. So for example, that's why high yield spreads in the United States are at very low levels. So if you're a low credit quality company in the US, you can now borrow extremely cheaply. And that's been good for the corporate bond market. It's been good for the equity market because a lot of the credit quality of companies in the S&P 500 is quite poor. On average, it's about single B. But the unfortunate side effect is that it's also inflated many equities to ridiculous valuations. So for example, here's the share price of Tesla since 2017. And you can see what happened after the big sell-off in March if we zoom in on this period on the right. So this was the sell-off that we got in March, and then the Fed stepped in and it also set interest rates to effectively zero. And then we got this phenomenal rise of Tesla in the aftermath. But what we've seen over the last month or so is that Tesla's sold off quite a bit, so about 23%. And there's a similar story if we look at the Chinese EV manufacturer NIO, which had a run-up of 1,600%. But over the last month, again, it's down by about 26%. But if we look at the broader market, the whole S&P 500, and here I'm looking at SPY, the massive S&P tracker, you can see that that's fallen much less. In fact, the run-up and the sell-off seems to be focused in the kind of companies which ARK Invest buys. So here's the ARK Innovation Fund, which has had an incredible rally of 350%, but again, it's lost about a fifth of its value over the space of a week. And as I suspected, after this pullback in markets, a lot of the people who'd been buying those ARK funds have pulled out their money. So on the 24th of February, as you can see in this tweet from Danny Berger of Bloomberg, about $465 million was pulled out of that single ARK fund. And then the next day, another $200 million was pulled out. Now, what characterises many of the stocks which are popular with ARK, but other fund managers like Scottish Mortgage in the UK, is that they're all growth stocks. These are companies which managed to grow their earnings very rapidly, and many investors were willing to pay a massive premium for that through the pandemic. Another more theoretical reason why growth companies are negatively impacted when rates rise is that their cash flows are more heavily weighted into the future because they're growing rapidly. And when rates increase, their present value reduces more. So one of the outcomes of the gradual increase in rates may well be a shift from growth, which has done very well over the past decade, to value, which has been out of favour for some time. So what's the big picture here? Well, what we're seeing is a world which is gradually recovering from the pandemic. That's not a bad thing, it's a good thing. And what we should see is that that's a good story for equity. Even though yields are increasing gradually, they're increasing from a very low base. So the cost of funding for companies remains low. It's more expensive than it was, but that's still not a problem. And in fact, I made a whole video about this for our YouTube supporters, because you don't have to just support us on Patreon now, you can do it directly on YouTube. And if you support us, you get to see that video. So if you are interested in reflation and the bigger picture, then that's certainly worth a look. I think what has a lot of people scared, including people who've sold off their bonds, is that we're going to see a massive inflation spike. But all you have to do is look at the commentary from the Federal Reserve and you'll see that that's not what they expect. And remember, these are people who have the kind of resources to monitor inflation that we could only dream of. Now, the measure they're talking about here is PCE inflation, which is personal consumption expenditures inflation. And what they expect is that that's going to go briefly above 2% in the second quarter of 2021. But that's because a lot of the US was shut down in spring 2020, so it has a very low base for prices. But then they expect inflation to finish the year at roughly 2%, which is of course their target. But they do expect it to gradually edge up above 2% by the end of the medium term. So there we're talking about a roughly 2-3 year period. And the reason for that is that labour markets and product markets should tighten. There'll be a bigger demand for the same amount of supply, roughly. And what they will allow is inflation to overshoot 2% because it's been below 2% for some time. This is their average inflation targeting regime, which they've just introduced. But this is that inflation measure on the Fred database. And if we do look at the values recently, it's extremely low. So if we zoom in on the recent period, you can actually see that the latest print was 1.5%. And here they've excluded food and energy because those are the most volatile components of the index. And if we look at a market-based measure of inflation, so this is looking at the 5-year forward 5-year rate of inflation, that peaked at just over 2%, and that was just at the beginning of February, but it's actually been falling since then. So now it's around 1.94%. So I think expecting a massive spike in inflation just isn't there in the data yet. There is a massive stimulus coming in the form of the latest plan from President Biden, $1.9 trillion, and the Fed is still very accommodative, but I don't think there's any sign that we have seen that inflation pick up hugely yet. You don't see it in the commentary from the Fed, and they should know, and we can't see it in the actual market expectations or even in the latest actual CPI print or PCE inflation. So what I expect will happen in the months ahead is that we will see the frothier parts of the market maybe see their valuations come back to more reasonable levels. But for the broader market, I don't think this is such a bad story. So if equity markets broadly do sell off, and here we're just talking about a correction, then I think that could be quite a good opportunity to get more risk into your portfolio, if you are tactical about it. But I still think the backdrop for equity is a good one. We have got vaccines which are working globally, and in many countries we are seeing a very effective rollout of that vaccination program. So that should paint a fairly good story in terms of getting activity back to something like normal. And central banks are still very accommodative. We still see them standing ready to support markets if there is an accident in terms of liquidity. And we've got the fiscal stimulus, which is still in place and still ongoing in many countries, including the US. So I certainly don't think this is a time to panic. I think you should definitely step back, learn about the reflation trade and learn to monitor it. Keep a very sharp eye on inflation and inflation measures, because an inflation shock could be very bad for markets. And if there is a big sell-off, don't panic. Remember, that's a chance to buy, not to sell. Well, I hope that's calmed you down, and I'm off now to write the weekly market roundup, which contains news stories about the reflation trade, but many other topics which are relevant to investors. It's a good way to learn about investing. And there should be a link to that in the description below me and next to me. And, as always, thank you for listening.